Ever get that credit card bill and just stare at the interest rate and wonder, how is that number even legal? Well, you are definitely not alone. In this explainer, we're going to pull back the curtain and show you exactly how this system was designed to work this way. It all starts with a number, a really, really big number, $1 trillion. That's the mountain of credit card debt Americans are under right now. Just take a second and let that sink in. It's a record high, and believe me, it tells a huge story. And it's not just the amount of debt, right? It's what that debt costs you. The average APR, that's the annual percentage rate, has also skyrocketed to historic highs. We're talking over 19% on average. And for a lot of folks, it's way, way higher than that. So you might be thinking, what are people buying with all this credit? Lavish vacations, designer clothes? No. For millions and millions of Americans, this isn't about luxury at all. It's about survival. We're talking about using credit cards to cover a surprise medical bill, a car that suddenly won't start, or just the basics, like putting gas in the tank and food on the table.
So that's the big question, isn't it? How did we get here? How did we end up in a world where so many people have to rely on high-interest plastic just to make ends meet? Well, to figure that out, we've got to jump in the time machine and go back a bit.
All right, let's dig into the history. Because the journey from like a simple IOU at a restaurant to the card in your wallet, it's a wild ride. And it really shows you how this whole thing was put together. Back in the 50s, things were simple. You had these little charge plates for specific department stores. Then, this guy Frank McNamara invents the Diners Club card, so we can pay for restaurant tabs. Cool, right? But the real earthquake hit in 1958. Bank of America launched something called the BankAmericard. And here's the key, the absolute game changer. It was the first card that lets you not pay the full bill at the end of the month. You could carry a balance. And boom, that's the moment interest becomes part of the equation. Now, for a while, the interest rates you could be charged were controlled by your home state, but that was about to change. Everything changed, really, because of one single Supreme Court decision in 1978. And weirdly enough, the story starts in a place you'd never expect, South Dakota.
Okay, quick sidebar, because this is super important. We need to talk about something called usury laws. It's a fancy term for a simple idea. Laws in each state that put a ceiling, a maximum limit, on the interest rates banks could charge. Seems logical, right? Well, the Supreme Court was about to flip the whole board over.
And here's what they decided. It was a total bombshell. The court said that the interest rate a bank can charge you is determined by the laws of the state where the bank has its headquarters, not where you live. This meant a bank could, in effect, export its home state's interest rate laws to every single customer, no matter where they were in the country.
You can probably guess what happened next, right? It was like a gold rush. Banks stampeded to set up shop in states like South Dakota and Delaware. Why? Because those states had basically no limits on interest rates. And just like that, a bank in Sioux Falls could charge someone in New York City an interest rate that would have been illegal in New York. Credit cards went from being a convenience to a massive, massive profit engine.
And that profit model created something that experts call the down escalator trap. It's a perfect way to describe why it feels so impossible to actually pay off your credit card debt sometimes.
Yeah, think about it as walking up the down escalator. You're putting in the effort, you're taking steps, but the whole system is moving against you, constantly pulling you back down. Let's look at how that actually works.
Okay, so picture this. You make your minimum payment for the month. That's you taking one step up the escalator. But then that super high interest rate kicks in, and that's the escalator itself moving down. So what happens? You're working hard just to stay in the same place. Or worse, you actually end up further down than where you started. And this isn't an accident. It's a design that can keep people trapped in debt for years, even decades.
And is this system profitable? You have no idea. In just 1 year, 2022, the big banks raked in $105 billion. And that's not revenue. That's just from interest and fees. Pure profit, all of it generated from people carrying debt.
So how does the business model actually function? It's pretty interesting, really. It basically splits cardholders into two groups. You've got about half of us who pay off the balance in full every single month. They don't really make the banks much money. But all that profit, it comes from the other half, the people who carry a balance from 1 month to the next. They're the ones caught in that trap we've been talking about.
Okay, so this all leads to a pretty obvious question. What can we actually do about this? And the conversation really breaks down into two camps: big ideas for policy changes and practical things you and I can do on our own.
So on the policy side, the big debate is about putting a national cap on interest rates. Proponents say, look, this is a straightforward fix that would save Americans billions of dollars practically overnight.
But the banks and their supporters fire back, saying, whoa, not so fast. They warn that if you do that, credit will dry up for most people, and it could seriously damage the economy. And to be honest, a federal rate cap just doesn't seem likely to happen anytime soon. So that brings us back to you. If you're one of the millions of people dealing with this debt right now, what can you actually do? Well, here's what the experts generally suggest.
Okay, 3 key things. First, attack the card with the highest interest rate. That's the one that's hurting you the most, so target it first. Second, look into a 0% balance transfer card. This is basically a way to hit the pause button on interest. You move your debt over, and for maybe 12 or 18 months, you can pay down the actual amount you owe without interest piling up. And third, be really wary of all the rewards marketing. The points, the miles, the cashback, it's all designed for one thing, to make you spend more money.
All right, let's zoom out for a second and look at the bigger picture here, because it's really easy to see this as just a bunch of individual people making individual choices, but it's so much bigger than that.
You know, this massive reliance on credit cards, it's often a symptom of bigger economic problems. We've had wages that just aren't keeping up with the cost of living. We have healthcare costs that can wipe a family out in an instant. And the result of all that is that more Americans than ever are living paycheck to paycheck, with absolutely zero safety net for when life happens.
And that really leaves us with one last big question to think about. When you have a trillion-dollar debt crisis, and it's being driven by people just trying to pay for groceries and medical care, is that a story about personal failure? Or is it a symptom of a much bigger economic problem that we all have to face?